Life insurance, and specifically cash value in life insurance, has been used a number of times throughout history to address needs of the policyholders. And one of the scenarios where it was used is during the Great Depression. And here we're looking at the situation. It's a blog post from MassMutual, one of the big mutual companies, a good company to have a whole life policy with, although I do have a preference. If I was going to, rather than go with MassMutual, personally, I went with Penn Mutual for my own policy. However, generally speaking, MassMutual you can get a great policy with if properly designed. And we're going to jump into that, specifically policy design, in this video, and that's what this video is intended to be, is breaking down the differences in policy design. But since the collapse of Silicon Valley Bank is happening, as of last week, and at the time of this recording, and right now, the FDIC, the Federal Reserve, and the Department of Treasury are doing a depositor backstop. It's sort of a moment in time where it's not all that different, or might not be all that different from the Great Depression if proper action is not taken. This video is part of a series. Check out the playlist here. Two of the most important things for a high cash value life insurance policy are the carrier itself and the policy design. In this video, we will demonstrate how you can have a terribly designed policy for cash value, even with a great carrier. In this case, it's Penn Mutual, but this applies to any carrier. If you're interested in working with us, check out the video description to book a meeting. But whatever the case, if your goal is cash value growth, then ensure that you're working with an agent that knows how to design a policy for that purpose. You can reference this video series to compare with illustrations that you might receive. And when we look here, this blog post, I'll leave a link in the description if you're interested in reading this blog post. It's directly on MassMutual's website, but just scrolling through here, you can see how they addressed the needs of their customers when banks were collapsing in Michigan. Specifically, they sent hundreds of thousands in cash, which was, adjusted for inflation, a significantly large amount of money. And so policyholders came to Detroit to borrow against their policy cash value in order to have some liquidity to meet their needs at a time when they really needed these things. If you're interested in reading this blog post, check the video description. I'll leave a link to it. But just understand that mutual companies, life insurance companies, have been around for a very long time. They're subject to many more restrictive practices as compared to our banking industry, which uses fractional reserve banking. That's what makes life insurance a really good store of funds, at least those larger balances that you might be storing inside of a bank. And that's sort of how I treat it. It's basically a savings mechanism that I'm putting significant amounts of money into. Personally, in my own policy, I'm putting in my whole life policy, I'm putting in $60,000 per year. And you don't have to have that much. We'll get into a lower funding level for somebody that's slightly younger than me. And you can make these policies effective with a few $1,000s a year, or even just, $1,000 a year, or somewhere around there. It just really depends on your age and your health rating. So let's jump into it with the policy design. We're going to be looking at what I would consider the worst funding strategy, what I might consider a bad funding strategy, and an okay funding strategy. Although the okay funding strategy could make sense for some people if you understand that it does take an early liquidity hit. And then an optimized funding level, which I would consider pretty optimized if you are okay with cutting off funding a little bit earlier, so not putting as much cash in over the entire life of the policy, but still having great returns. And then lastly, the optimized max funding, pretty much as close to getting as much cash into the policy as possible while at the same time maximizing cash value in the early time period. So that's what all of this is, and what we're going to do is just really quickly walk through comparisons of some spot checks of these cash values against the actual illustration that we created. So looking here, in year one on this worst funding one, we have $2,831,257 as the death benefit. So if we look over here in year one, $2,831,257. So that's the death benefit, and in year one net cash value of 0. So that's the case on this sheet as well. So you'll see in this one we don't have cash value. We don't have cash value for the first 2 years on this one, which is, in my mind, not at all what I would want. There are better ways to go about this specific need, and I don't prefer this at all. Then next we can look at the bad funding level. And we have total death benefit of $4,840,333. And if we look at the illustration for that policy, that is right here. So we have that same amount right here, and total cash value $2,479 in year one. And you can see that is the case right here. So then next we can go to what I would consider an okay funding level. And there are some circumstances where somebody might want to do this. It wouldn't be my personal preference, but there are circumstances where if you were very risk averse and you just wanted to fund with as much as possible for as long as possible, but still get a decent return, this is okay. That's why I would consider it an okay funding level. But you can see here, we've got $13,497 cash value in year one and $2,378,353. So those are the initial values. So if we pop over to that OK funding level, we can see that 13,000 and some change and 2,300,000, almost 2,400,000 right there. So next, let's pop over to the optimized funding to age 61. So in this case, we have significantly lower death benefit, and that's part of what helps optimize this design. We lower that death benefit to the minimum necessary in order to get the amount of cash that we want to into the policy. And what that results in is $20,000 cash value that you have access to in year one. A high percentage of that, or 90-something% of that, you should have access to in year one. In my case, it's like, I don't know, 95% of my net cash value I have access to in my own policy. And this carrier in particular is Penn Mutual. That's who I have my whole life policy through. So that's one of the reasons why I wanted to walk through on this. But there are other carriers. There are other carriers that have great products. I just wanted to walk through how one carrier policy design absolutely matters, and it is the most important thing if you're trying to maximize cash value, and in the end, also death benefit. So looking at that, we have these values here for funding, max funding until age 61, and so 847,860, and that's what we have there, and then that 20,000 and some change in year one cash value. And lastly, we'll go to this max fund. It's optimized max fund. The values are actually exactly the same in year one because design-wise, this is almost exactly the same, except what we're doing is we're funding for longer with higher levels by tweaking the amount of paid-up additions that we're using. I have other videos on breaking down some of the mechanics of how whole life builds cash value and how we use paid-up additions to do that. So check the video description. I'll have links to that, or you can check out my channel pages on the infinite banking concept and find more content around this if you're looking to learn some of the more ins and outs. This video is just intended to walk through this comparison of the different cash values and death benefits for optimized designs versus less optimal designs. And now we're going to jump into comparing a spot check of later on in life. So we're going to just spot check age 80, or let's say 85. So a realistic, well, actually, I think modern medicine with people who are opening policy these days, let's just say age 90. I think that's a realistic life expectancy for a lot of folks who might be opening a policy. So when we look at this, in this case, we've got 11,816,000 in death benefit and 10,538,000 in cash value at age 90. So if we look at age 90, so 11,816,000 and 10,538,000 in total cash value. So just to spot check, like big differences in age. We're late in the policy. That's what we're looking like, and we can see that we've got over the life of this policy about a 5% internal rate of return, and it starts to go down from here just because the cost of insurance does get more expensive, and so you'll see that a little bit where it tops out in the 70s. But yeah, so around a 5% internal rate of return over the entire life of this. And this is why I was saying there's a lot of folks who are talking about buying treasuries right now because yields are around 5%. This is something that likely will yield higher than this. We're likely going to see as interest rates go up. My policies will probably outperform if we look over the next 10 years and compare it to what mine are currently doing, because we've gone into a rising interest rate environment that will benefit the insurance carriers over the long term. That's something else to consider. But we can see that we got a pretty good internal rate of return, and at age 90, we've got some decent cash value and decent death benefit. So if we go to the next policy, so this is where there's some disconnect between these two optimized ones. So we're sort of working our way back now. Go to age 90 on this as well. Here's age 90. We can see the death benefit of 11,533,000 and total cash value of 10,284,000. So if we compare that to this, it's right there. Those values match. And if we go to the OK funding level, so this is the OK funding level. So let's go over to this and bring it down to age 90. And again, all this is an illustration, so it's not necessarily, this isn't just the straight guaranteed portion. I think very likely we should see this outperform in my mind. This is something that there's a portion of this that is guaranteed, but not all of this return and what the values we're looking at are not the guaranteed portion. It's just very, very secure in that these companies have done returns over the long term. So here we've got total death benefit of 11,940,000, so it's slightly higher, and we've got total cash value 10,625,000. Age 90, so there we go. So that's there. Then now what I would consider bad funding strategy. Let's go ahead and take a look at that and go to age 90 on this sheet. So really just spot checking again. We've got under 10 million, so 9,854,000 and 11,119,000. Yep, that's right there. Age 90, that matches. And lastly, the worst funding level. This actually looks even better than the bad funding. And a lot of what I say in terms of the bad funding is sort of this early liquidity. But so you'll see here, though, we've got 11,542,000 and 10,219,000. So if we look at here, yep, so same. Just want to show all these values match, and you'll see that some of these internal rates of return go down with some of these other funding levels. So notice that some of the funding levels are weaker internal rates of return over the long term. So that's really all I wanted to show the actual illustration for, to just say like this is what these values were pulled from the illustrations, and that's mainly for comparison. So we're really going to talk through the spreadsheet, but before we do that, I do want to discuss whole life dividends historically. So here we have a spreadsheet of the historical dividend rates of mutual companies, whole life companies that I would like if I was opening a policy for myself. When my wife and I design policies for people, these are the carriers that we're looking to do for whole life. I personally like Penn Mutual and Guardian for two different purposes. Guardian gives you much better funding flexibility, and Penn Mutual less flexibility, but likely is going to have some stronger returns. And so some of that's bared out in what you can see here. But any one of these would be a fine carrier to have a policy if properly designed. And all of these are gross dividend rates, so know that there are some expenses, so your actual crediting might be slightly less than this. This is what drives at that internal rate of return is, when you look back to, in this case, we're just looking back to 1991. So this was coming off the back of a rising interest rate environment of the 80s that was sort of in response to some hyperinflation. So similar to a situation that we might be in right now. So this is what the dividend rates looked like. And so illustrations that might have been done in these timeframes would probably have not done as well if somebody got an illustration in 1991 showing these kinds of illustrated rates. But you'll notice that in this near zero, when we go more toward the modern era, in this near zero interest rate environment that we've had for the past, basically since the financial crisis, so since 2008, like 15 years or so, these companies have still paid out strong dividends. When this gets credited to your policy, remember that we have ways that you can access these gains tax-free through either partial surrenders with accessing the cash value, or policy loans. This is why this is a fantastic place to park money and get secure returns over the long term. With all that in mind, when we're talking about these rates, that they were held down by virtue of the fact that the interest rate environment was extremely low, for a very long time. And so that's where these companies are really just starting to get to what would be rock bottom after over a decade of those near zero interest rates. And so you'll see that they're slow to move, they're slow to increase, and they're slow to decrease what they're paying out because they're doing extremely secure investments and holding some of these investments over the long term, whether it's mortgage-backed securities or treasuries or whatever, municipal bonds, investment-grade bonds. They're doing a lot of these very secure investments, whereas what we saw with the situation with Silicon Valley Bank and the bank run, they were sort of forced to sell some of these securities at a huge loss because banking and fractional reserve banking does not have the same reserve requirements that insurance do. So the insurance carriers keep giant reserves in order to facilitate death benefits at any given time because they're going to pay death benefits out every single year. So they have reserves, putting some room in between what they project for death benefit payments and even adding some margin on top of that. So it's just we're significantly less risk than what a normal bank of a fractional reserve banking system and something like Silicon Valley Bank is doing. So that's just to show some of the historical returns of these the dividends on these mutual companies.